Welcome to the next topic, which deals with impairment of long-term assets. This is a departure from the cost principle in which we say that the assets are recorded at cost and we keep them at cost until we actually sell or dispose of the asset in some way, shape, or form. So why would we actually depart from that particular stance? Let's take a look at this chart over here and see what we're dealing with. If we expect the future net cash flows to be generated by the asset is going to be less than the carrying value of the asset, then we say we have an impairment. We are saying that this asset is not going to justify its existence in terms of the carrying value. If the future cash flow is more than the carrying value, we have no impairment. We don't have to do anything. So if the recoverability test, we say the asset is in fact impaired, we then need to identify, is the asset held for use or is it held for disposal? Held for use means I'm going to continue to use the asset despite the fact that the future cash flows are not very promising. In that case, impairment loss is calculated as the excess of carrying amount over the fair value of the asset. We are going to write down the asset. We're going to take the impairment loss to bring it down to fair value. Fair value means market value of the asset. Depreciate on the new cost basis, and the restoration of impairment loss is not permitted. What this means is, in future, let's say a year or two down the road, things start looking up and we think that the future cash flows are going to be more than the carrying value, we're not allowed to reverse the loss. If it's held for use, we are allowed to reverse the loss. They're not going to take depreciation because the asset is held for disposal. And the impairment loss is calculated as the excess of the carrying amount over fair value less any cost to dispose. Let's look at the example we have here. Jurassic Company owns an equipment that cost is $900,000. So far, we have depreciated it $380,000, which means accumulated depreciation is $380,000. The expected future cash flow of this asset is $500,000. The fair value of the asset is $400,000. This asset is held for use in the business, what we talked about over here. They're asking us to do the recoverability test and decide whether we need to do a journal entry or not to record impairment loss. So let's start by bringing forth all the relevant information. The relevant information we have here is the original cost of the asset is $900,000. The accumulated depreciation is $380,000, which means my carrying value or book value is $520,000. I'm told that the future cash flow we expect is going to be $500,000. The fair market value, the fair value is the market value today, is only $400,000. So let's start with the recoverability test. Our question is the net cash flow less than the carrying value? So let's write down that information over here. The net cash flow in the future is $500,000. My carrying value is $520,000, which means, yes, I have a loss, an impairment loss. Now, the next step is to calculate the impairment loss. The impairment loss is going to be the carrying value minus the fair value is going to give me the impairment loss. So those amounts are 520 minus 400 is going to be 120. The objective over here is to write down the asset to the current fair value. I'm departing from the cost and I'm going with market value. Like we had done for inventories, we are now doing it for long-term asset. But this is only in the event that we think that we have a loss sitting out there in the future. So how do we do this by way of journal entry? The first part is easy. We know impairment loss has to be debited. We also know the amount. We've already calculated the amount. The question is, what should I credit? The account I'm going to credit is accumulated depreciation. So what's the effect of this? Let's take a look at what we had before and after the loss. The original cost of the asset, that's going to stay the same before and after. It is what we paid. It is what it is. What's going to be different now is my accumulated depreciation. What was the amount before the loss? We said it was 380. Now, after this loss was taken, I credited accumulated depreciation 120. So which means accumulated depreciation increases to $500,000. So what's the carrying value of the asset? Before the loss, it was 520. After the loss, it's 400. Now this becomes a new basis for depreciation. Here what they tell you, depreciate on the new basis. 400,000 is the amount I need to depreciate moving out into the future. In this case, we've just been asked to do the journal entry for the loss. But if you had to calculate depreciation expense for the future, you're going to use 400,000, not that original 900,000. This is the number we're going to use for the remaining life of the asset. So once again, first step is compare the future cash flows with the carrying value of the asset. If future cash flow is less than the carrying value, we have an impairment loss. If not, we don't. If we have a loss, look and see in the problem. Have they told us about, is the asset held for use or held for disposal? If it is held for disposal, you'll always be given that cost to dispose. If they don't mention the cost to dispose, you can assume it's held for use. So the carrying value minus the fair value is going to be your impairment loss. That's the journal entry we have here. Impairment loss debit, accumulated depreciation credit. We are bringing it down to the fair value or the market value of the asset. So this is in case of impairment. Typically, this happens when a company has assets that are bloated and the economy tanks. That may be the opportunity for a company to write down their assets, cut your losses, and move ahead. So this does happen, not too often, but when it does, we know how to do the journal entry.